Derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results.
So stressful. And the world's on fire. Good God. I can't look at this, guys. Like, my strategy is you buy it and you hope that you gotta get spotted. Yeah, but we all think you're crazy. You don't fight this. No way. The markets are freaking out and you don't think that anything is wrong? Come back tomorrow and I'll lose it all. Should be fun.
Good morning, everybody. Sorry, I am like super late. We just got the non-farms news. They are selling pretty hard here. We had where are we here? Oh shit! Average earnings month over month, spot 5 versus spot 3. Okay, well, I am dead in the water here with micros, right? This could continue down. This is bad for the treasuries, but I do not think that the micros are updating very well and that it would be wise to try and trade them here. This is one of the largest just off the news moves I think we've ever seen. That's pretty wild. Like, I can't believe that the 5-year is in there at 2.75. I don't know if the on the run numbers will be useful here or not, but like, shouldn't we be, well, let's see here. Okay, the other day when we were at 2.8, we were around 119.16. So I think that might be right. So we had the private payrolls. Oh, wait, 471? Wait, am I reading that right? I thought he said 275. I did not hear that right. Holy shnikes, that can't be right. Forex Factory is telling me 528. Yeah. Well, the issue is you've got a really ugly oh boy. I was not prepared for that, man. 528? You've got to be kidding me. There's no way. There is no way it could be 528. That's crazy. S&P 500 really didn't like that, did it? Good 30-40 point drop. I don't think that the liquidity here in the micros really fits us for a trade, and I am really concerned about pullbacks. When it came down to 120 at first, I was like, well, I don't know if you want to take that one because it'll shoot back up. But then I started looking through the numbers and I was like, wait, what? It was a private payrolls 471 versus 230. Average hourly earnings spot 5 versus spot 3. How and what was the household survey? The household survey, the unemployment rate went down. It went to 3.5 from 3.6. What is going on here, guys? It's half. Okay. Oh, man. This is nuts. Well, things are maybe a little better. I have some food. I'm going to eat this food. We're going to watch this. We're going to turn the music on. We're going to do some chill step today. I got to think about this a little bit. We're definitely in like a bad news is good environment, but the number like that, oh jeez. Oh my gosh. No, we're gonna wait. The tagline on Zero Hedge, we are now well and truly in Bizarro world. I'm still in disbelief. I don't believe the number. I seriously, that can't be right. I'm done it wrong. How is that number? This is really, the number is just zany. The only situation I can think of that's even remotely comparable was when, after the pandemic, we were expecting we were expecting a negative number and we got an extremely positive number. And it was kind of like ever since then, the numbers have been kind of screwy, right? That number is just crazy. The problem that I see here is that the market keeps doing really unexpected things on non-farm payroll days, and it keeps doing unexpected things around interest rates. So this number was really big. This substantially increases the chances of a 75 basis point hike in September, which would put us at 3%. And, you know, further rate hikes further on down the line, and the longer rate hikes. Of course, the big print that really matters to all of that is going to be the CPI. But if the jobs number is that high, it makes you wonder about the CPI. I mean, it really has to be like all of those people that got laid off by big tech companies and so forth have to be like have already gotten new jobs or something like that for that number to work, right? That's what I'm kind of thinking here. But such aggressive rate hikes also substantially increases the chances of this turning into a recession, right? And so the bond market has been doing this thing where it's like the faster they raise interest rates, the faster we go into a recession, the faster they turn the pipe back on. And so we are seeing flattening on this move, especially in the knob spread. There's definitely some flattening between the 10 and the 30, right? What's for breakfast? Just a croissant. Okay, so one thing I want to point out here that's kind of curious is the 10-year note. The cash note is actually pretty close to in line with the micro yield futures at the moment. So the basis between the cash and the future is basically disappeared during this move. The spread over there is actually much wider than what it is here in the micros. Okay, we are just kind of ranging around here. I'm a little bit worried about a pushback move. I don't think I've seen the conditions quite yet where somebody would hit back, or rather there is, you know, there's the inverse sine law, right? So there is a point at where if you want to take the opposite trade, there kind of becomes an optimal period where you'll have maximum impact, and I don't think that we're quite there yet. So that's why I'm still being a little bit cautious, and I haven't taken anything over here. I sure would have liked 2.8. I saw it and I was like, oh, I could click that one, and I was thinking about it, but it was the market was way too fast, right? So I wasn't even close on that trade. The other thing is that I am seeing substantial flattening. I can't really see, man. So in ZN, I'm to do like my ZN ZT spread. It doesn't really show you what the actual inversion is, but it's almost like 40 basis points now at this point. What about some QQQ calls? Oh, I don't know about that one. This news is such a strong outlier beat that it has a higher probability of developing a trend day. I think particularly in the equities. I think the equities are probably going to get hit the hardest. Paradoxically, I think it will be stronger than in the treasuries. This move really is crazy. It kind of scares me to think about trading it, honestly, is kind of what I'm dealing with right now. Because in all likelihood, not in all likelihood, a lot of the time in situations like this, you can just close your eyes and pick a spot. It's gonna go, right? But this is scarce. This is scary. I cannot explain this number. There's got to be some stuff in here. Okay. So let's read the zero hedge story now. They've updated it a little bit. In a time when the US is in a technical recession, when tech companies are mass laying off thousands of people, moments ago, the BLS reported that in June, the US added a whopping 528,000 jobs, more than double the 250K expected, up solidly from last month's upward revised 398K, and the highest since February's 714K. Just how ridiculous was the last monthly cooking of the books by the BLS? So ridiculous that the reported number was a 6 sigma beat to expectations. Reading between the lines, there was 471 new private payroll jobs added, more than double the 230K estimates. Not surprisingly, the bulk of the new jobs came from the service sector. But not only did July blow away expectations, but both previous months were revised higher. The change in total non-farm payroll employment for May was revised up by 2,000 from 384 to 386, and the change for June was revised up by 26,000 from 372 to 398. With these revisions, employment in May and June combined is 28,000 higher than previously reported. The unemployment rate also declined, sliding to 3.5 from 3.6 and below the 3.6 estimate as the number of unemployed persons edged down to 5.7 million. These measures have returned to their levels in February 2020 prior to the coronavirus pandemic. Among the major worker groups, the unemployment rate for adult women and whites declined in July. Jobless rate for adult men, teenagers, blacks, Asians, and Hispanics showed little change over the month. The participation rate, however, declined again from 62.2 to 62.1. It wasn't just payrolls that smashed expectations either, however, as wages came in red hot. July average hourly earnings rose 5.2% year over year, smashing expectations of 4.9% and increased spot 5% month over month, also beating estimates of spot 3. Additionally, the average work week was 34.6 hours the fifth month in a row, beating expectations of a decline to 34.5. In manufacturing, the average work week for all employees held at 40 hours. Overtime increased by 0.1 hour to 3.3. The average work week production and non-supervisory employees on private non-farm payrolls remained unchanged at 34 hours. While we are digging through the number, the report will surely boost expectations for a 75 basis point hike at the Fed September meeting because, as Bloomberg notes, this is not at all what the Fed wanted to see. The job market, if anything, is getting even hotter, not cooling. The only thing that could reverse the narrative is if next week's CPI print comes in far below expectations. Well, now we're getting the more of the extended pullback that I thought we might. Wage spiral. Okay. Well, okay, so first thing I want to know is that they did say that it was coming from services. So it does kind of seem to me that like there are some businesses that were still kind of in a little bit of pandemic mode and now they're like completely back to normality. Of course, they didn't say it outright, but they did say about cooking the books, like kind of suggesting that the BLS is cooking the report. I just how do you get, man, something's not right, like seriously, because again, how do you get the Federal Reserve is raising interest rates 75 basis points at a time, the stock market is just getting absolutely murdered, and meanwhile the jobs market is just like absolutely taken off. And another thing is, why is consumer sentiment and all of these other things so poor if the jobs market is that great, right? So I see so many people saying, oh, like the jobs market, it's not really that good, it's all kind of a farce and yada yada. There's not as many, they're actually not actually hiring, and I just, you tried to long the 10-year yield, but it didn't work out for you. Yeah, the S&P 500 is going to be posting like a triple-digit decline today, probably. What are we at right now? Well, so far NASDAQ is, and man, silver down 2.5%. If the services number is so great, why did 47% of restaurants not pay rent last month? Well, if maybe they're still, I mean, That could be them ramping up. I don't know. I can't explain the number, man. I can't. I was not. So I remember last night reading Zero Hedge's, like preview for the number, and they were on this whole, good news is bad sort of a thing, which understandable, sure. And they were saying, okay, so what if it's under the expected 250, right? That would be pretty bad, but that would be good for the market because that means that the Federal Reserve can back up. What if it's at the higher end of the estimate at like 400,000 or something like that? Okay. Goldman's estimate was 225, right? What if it's at 4? And I remember thinking that, and I was like, well, there's no way it's going to be over 400. That's silly. There's no way it's going to be over 300. That's silly. This is such an insane beat. Wow. Well, when that came back, the yield, man, I don't like that. There's definitely some opportunity here, but the volatility just scares the hell out of me, man. Because when it was below 2.8, I was thinking, okay, I think we might get the pullback, maybe 120 even, maybe further than that. We got to be careful about somebody hitting back really aggressively here, right? And it came back to above 2.81 so quickly. So I'm kind of feeling like it's still too volatile for me to trade. The liquidity is there in the micro. I think I could take trades over there. It might make more sense to do it in the 2-year. Although the 2-year is at 3.2 now. Umbrella says, I don't get it. Metals are supposed to go up in inflation. Well, you would think that, but the pattern over the last 2 years or so has been that metal follows the interest rates. If the treasury is being sold off, then gold and silver sell off. And silver in particular got hit really hard. Really hard. It looks like the basis is returning. The 10-year over on TradeWeb is more like 2.79. So they're about two and a half basis points different now. When interest rates go up, bonds go down. Correct. You're going to see selling in these top ones, the treasuries, and you're going to see buying in these bottom ones, the rates. All right. My lips are really chapped this morning. We've rotated around that area like really quite excessively, haven't we? I think I've kind of anchored my expectations at 2.8, and I keep thinking, oh, I could get below 2.8. I don't know if these prices necessarily make sense, though. We're still kind of, they're still balancing. The liquidity hasn't completely recovered yet. You know what? As another thing going on right now is that the Democrats have a bill going through Congress, and they made a deal with with Senator Manchin, who was kind of holding it back. Wow, that was a big offer, and they just gobbled it right up. Anyways, there was concern that Senator Sienma would stand in the way of the bill, but she got a couple of carve-outs for her, and she signed on to it as well. I really wonder, now the bill is supposed to be called the Inflation Reduction Act, but the estimate so far kind of suggests that it won't really do anything for inflation. Also, a lot of the cost-cutting measures in the bill are being taken out by Sienma. Like the big one was the basically, if you're like a hedge fund manager, there's like a special carve out for you, and they were going to get rid of that carried interest or whatever it is. So the bill will have to be rescored, might not have as much cost savings as it did, right? I kind of wonder if after all of that is said and done, and then you look at this number, it's pretty bad. I mean, it's not pretty bad, but I mean the jobs market is booming basically, and then you got the CPI next week, right? So if CPI is high, does Manchin maybe change his mind and they scuttle the deal? I think it would be pretty bad for him if he went back on it. So I don't think that he will, but that could play in. That could be a negative for us overall. I see the case for interest rates staying higher for longer. I'm a little interested now to see how this yield curve thing goes, because it's starting to feel to me like the 2-year is headed for like 2.5, while the rest of them might have a hard time getting above 3. I just can't believe I'm still just in awe of that number, man. I can't believe that it was such a massive beat. Is just zany. Like every other tea leaf that we've been getting has kind of been suggesting that the job market has really been cooling off, and that, you know, we're possibly in a recession and all of this sort of stuff. And then we get this report as nothing makes sense. That 30 years pushing down pretty hard. Not enough to make it steepener, but okay, Ed Morrissey has some more context around this. The New York Times got out ahead of this morning's jobs report with a warning that we should expect job growth to slow in July thanks to Fed action to tamp down inflation. Oops. And then he points out in the report, we added 528,000 jobs, but sent another 303,000 into part-time work for economic reasons, while the labor force shrank by 239,000 and wage growth remains steady and far below inflation. No, that's wrong, Ed. Wage growth was well above what it should have been. I guess the wage growth number, average hourly earnings was 0.4 before. Holy shit. Well, that's I'm done. There's no good grief. Wow. Wow, guys, did you see that? Oh my gosh. No, you don't want to touch that now. Oh, there's a lot of volume trading down there though. What the hell was that? That somebody puking? I think somebody just puked there. That was nuts. And here I am still waiting for 2.8. Did you see? I even put a limit order out at one point. Shit. Yeah, they just dumped like eight ticks all at once in the 10-year. Was just like whoosh. And they were trading through thousands of contracts each step too. I'm just laming at this point, been short since. Well, I did it on my sim account, but I didn't do it on my live account. I'm too chicken. This is 25 bucks I could have had. Is it a big deal? I don't know. An impulsive move like that creates real problems for us on the liquidity side, though. Like, look, some of these prices above us, below us, it's not too bad, but some of these prices below us are like 600 lots. So the momentum is definitely to the downside. Oh man, I mean, look at that. The momentum is definitely to the downside. And the 6J is just dumping and dumping and dumping. But it's a little difficult for me to want to just hit into it. Well, I could do it there at 283. 283 wouldn't be terrible. But if I do it, I think I would want to be out quickly because there's a really large risk of getting sucked back up. And like, look at how far up it could go. I think I'm supposed to take off these if I get to... News Squawk tweets, Fed semester yesterday said she pencils going a bit above 4% on interest rates and holding them there for a while. Those comments have more weight after the non-farms payroll. Did she know? Did the Fed know when they did their I don't know. I don't think they did. Wonder if it makes sense to try and hold this over the weekend is another thing I'm thinking about. Like on Fridays, we're often got to be careful because you don't want like to be messed up by profit taking and rebalancing before the weekend. But I would think if I was a swing trader, like if I still had that swing trade on, I'd be up a little bit, right? Because I took mine off at like 2.79, so I'd be up another $25. Not quite to the maximum amount that I had on that trade, but getting close. And you know, expecting more, expecting maybe 3% again. So I think that those swing traders might have a little bit more confidence holding into the weekend because of this. What Jim Iorio says took a multi-day long at 4105. You're insane, dude. I think you're crazy. A little too crazy for my tastes, man. And he says a multi-day long too. Downward pressure is just still there, man. Okay, there's my 1,000. Start adding back up around 20. So there is that 1,000 lot at 17.5, but then above that, like again, there is less liquidity here on the offer than there is below. There is like a real liquidity holes above us, so. Fitch says, recession? What recession? The U.S. economy is creating jobs at an annual rate of 6 million. That's 3 times faster than what we normally see historically in a good year. Well, this goes back to something that I've been saying for a while now about the GDP number, is that it seems to me that the GDP number is negative because exports have completely collapsed because the dollar is so strong. But the internal economy seems to be fine, and like people are just moving over into services jobs. I don't know. $283 was where I was saying before. Well, I could hit that, right? I don't know if it looks so great right now. They're forcing me 385. Well, somebody took it. Somebody took it. Let's see how it goes for him. So far, that's good. I mean, that's a good as she goes so far. Not quite. A little bit more added at 16.5 at that time, though. So in terms of like the next meta order, it did come a little bit early, but I think that we're in that, and it doesn't look like they've reached impact, the extent of their impact yet. Well, there you go. That 8-3 would have been a great trade. $14.5, a little bit more liquidity there. Sitting here waiting for the perfect pullback. It kind of came. It wasn't quite as much as I thought. They are extending lower now. I really don't think I can take a trade. I think I blew it. So the low from Wednesday, was it? 119.10.5. So we're coming up on a support zone with quite a bit of momentum. Spread came in again here too. Silver is now down 3%. Jeez. I mean, ES is down 1%. Now to open down 1%, that's a lot. So okay, well maybe there's the kind of the little backwash. Thinking back on some of the spots where I could have taken it, I don't know how much heat I would have taken on them. The micro futures are really like front running the rates over here. They're still back at 283. They did bust through that resistance. Oh, and look, a large order at 12. Noticing slightly larger transactions here. Oh, I thought I had another contract, but I'm not. That's okay. I want to get out. Maybe back up in here. I'm wondering some of what I've seen and the kind of patterns that we've seen when we've had these really strong moves in the treasuries as of late. They might go lower, but it wouldn't surprise me to see at some point a return back to 20 area. That's just been the amount of volatility and backwash we've had on some of these days. So, which again has kind of made it hard to take trades. Yeah, okay. So there is a substantial amount of volume trading here at 12 half, substantially more than there has been at any other point along this move. So that's definitely going to create a liquidity hole of some sort. The question is if it flips back around here. Timing of it is a little odd. Just before the S&P 500 opens up. Bank of England Governor Andrew Bailey denies that officials acted too slowly on inflation, saying interest rate hikes a year ago would have damaged the recovery from the pandemic. No. Don't agree with that one. Acting earlier would have been better. Like it was like we had a huge stock market mania and all sorts of crazy stuff going on in 2021. And they were like, no, we need to keep interest rates low. And we were like, you guys are crazy. And now they're like, no, we did the right. No, you didn't. Come on. I understand why you did it, but just admit it. There was a mistake. You were short from the 60s. Oh man, Oliver. It is a big drop in the S&P. Like 1% drop overnight. So what do you get on that, right? When you're that far outside of the previous day's range, you're either going to recover the overnight gap or you're going to continue down, right? If we continue down, I think you could see a 2.5% day in equities. Yeah, to have been short from 4160, it probably would have been a little bit of luck, right? Because you wouldn't have known that the news was coming. Well, what's with this? 32,000 more people had jobs in July of 2022 than the number in February of 2020, the last month before the lockdowns. What says great economy if not adding 32,000 jobs in 2.5 years? You were asleep during the news? What? There was good news. Good news is bad, right? Good news is bad. don't know. Jimmy said took it long 4105. He's doing okay so far, but we are going to have the open here, right? You know, you would think that a data point like this would cause a lot of people to just say, oh, you know what? We really don't understand what's going on. We don't really have the ability to really understand real time what is happening in this economy. But I bet you they're not going to actually say that. That's where I'm at. These economic numbers that we've been getting past 2 months. No clue. I have no clue. Cannot explain what's going on. Hey, Tobias, how are you doing? It's been a minute. 16's not terrible. Oh, you're on NinjaTrader now. That's cool. You know, I've kind of been on the platform journey the past little while. And when I go to other platforms, I'm like, oh, yeah, I can do all of the same things I can do in NinjaTrader, except for it's easier to program over there, you know? But then I start using NinjaTrader and I come into all of the limitations in NinjaTrader that are bothering me right now. And I really think that the end solution is Seth makes his own platform. You know? I am saving the data. It'd be interesting to see how much today's is, because today is obviously a huge day. Probably going to be much larger file size. But if it's only like 100, 200 megabytes a day, I can pull that. Now the question is, should I put it in the cloud? You know? Oh, it'll take a long time to abandon NinjaTrader. I mean, the issue is that I only use it for the charts. I have a hard time seeing another platform that's better in terms of charts. Like if I make my own platform, I don't think that it will necessarily be better than NinjaTrader's in terms of charts, right? I think that it would be more stable and perform better and be better for algorithmic trading, but I don't think that it would be better in terms of charts. How much is Google Cloud? Hey, what you use? Estimate costs, pricing calculator. Trying to find the Google prices for cloud storage pricing. Oh, that's not bad. Standard storage, 2 cents per gigabyte per month. So if we had a year's worth of data, right? So we're talking about 200 per day times 254 trading days a year or so. So 50 gigabytes times 0.02 is $1,000 a month. Is that? Am I getting that right? No. It's 50. It'd be 50 times 0.02. There we go. So it'll be $1 a month. So it actually does kind of make sense to store it in the cloud. Although you'd want to pay for computing in the cloud too, because you don't want to pull all that data down to your machine every time. Either way, I think I would find myself doing it on my machine more often than not. Program my first strategy. I added a custom data series, but it's not showing as the input series for indicators. I have to figure out why. Oh, that is a little weird. You mean value 0 doesn't show, is not the... So I'm seeing another spot of high volume happening here at 15. Look at that, 41. The S&P 500 is recovering here on the open. Where's my chart? And it's quite a bit of volume too. Well, the relative opportunity available in ES right now is a little sketch. Yeah, he was saying he was kind of short from there, but he didn't get it to go. He made money on the core position, but then he got stopped out. What the hell? Did you see that? This is 6K at 17. What? At 17, and then they canceled and they traded through it. What? Okay, he's fishing. I don't want to participate on that, right? You fell asleep. Are you in Europe then? Where are you? Or are you the US? You in the US and you were up all night trading? Dude, that's not good. Another day of huge initial balance, maybe one more breakout site, and then the rest should be black fill. Yeah, I'm kind of thinking that as well. But the treasuries at the moment are kind of suggesting maybe a counter order. But there's shenanigans. There's real shenanigans going on at 17, okay? Used to get up at 3 a.m. to trade the London session. Yeah, my mentor, he was doing that before he passed, and he was doing quite well with that, waking up early for the London move. Yeah, there's 18, so... So one of the things that I was thinking about after that move was like, okay, if I had taken 2.83, would have gone really well initially. I wouldn't quite have gotten $20, and then it's coming back. And I know that that's just kind of like the way that it goes often. Is usually for me to get a runner, it's like it comes all the way back, and then it extends twice that or something like that. That's how I usually get my runners. So that's why. And then when it's like a really sloppy move too, that really makes me cautious, because why again? Such a sloppy move is going to create a massive liquidity hole, right? I mean, there's a massive liquidity hole down at 21, down at 12, but the liquidity probably going all the way back up to 24 is probably severely damaged. So that's where it kind of trying to take the trade of it falling below 14.5 is a little difficult of a trade to take because of the liquidity, right? Doesn't predict that it's going to do it or it's not. It just says it's a difficult trade from the risk management perspective because of the liquidity conditions. And now that we've done this, depending on how high up we go, things might reset. So, like Octavia says, it might be like just backfill at that point. But it's such a huge change in expectations that it could absolutely continue through. We're only down about, I'm gonna say 62.86. So we're only down about 24,000 contracts on the day. So there could certainly be some rebalancing and then further move later on in the day, right? I'm quite impressed by the S&P 500 coming back up here. What? U.S. Labor Secretary Walsh expecting jobs growth to be sustainable. Okay. That's like Baghdad Bob levels of. Like number one, it's Baghdad Bob levels of like gaslighting here. Like, you're saying that for political reasons. You don't have an effing clue. It's what the hell? Wait, am I? Oh, you know what? My dollar index hasn't been updating this whole time. Well, I have it over here, don't I? Let's see if I can get the other one to do it. Low to mid 30s should be interesting, NES. Well, so this price right here, 41.36, is what? Previous day's low? I'm not exactly sure where that is coming from, to be honest with you. Was it a day's low somewhere? Okay, yeah, it was. It was previous day's low. A lot of these my Ninja Trader charts are so screwed up. But I don't want to restart Ninja Trader because I don't want to lose my data gathering in the 10-year. So here's the thing: if I turned this into into the cloud, this data gathering, and I started putting it in the cloud, and I wanted to make it available to other people, what would be the right way to make it available to other people? Because the issue is still like, you don't want to download it off the cloud and put it on your own machine, right? If it's in the cloud, we would rather just do all the data processing in the cloud. So how do I make it so that, well, maybe I would have to make it so that you would have to you'd have to get your own nodes, but I could still give it access to the data? Use an API. I don't think you understand. You don't want to download it to your machine, right? I don't know enough about Google Cloud. I think that I could make it like, okay, you can get your own compute node and you can put whatever you want on your compute node and pull the data, and then the data would get pulled through, Google's backbone and everything. Yeah, you could do Kaggle too. Let's look at Kaggle. Your machine learning and data science community. Oh, I think that Kaggle just uses Google Cloud. All they do is host the competitions and stuff. Yeah, but you can create endpoint in the API and the users can access the data they need. Well, one thing that I could do, so here's why we're kind of the driver behind all of this, okay? So I say you're doing cumulative delta, okay? So you look at what the best bid, best offer is, and then you take your new order and you compare the price of that new order to what the best bid, best offer is, and you use that to compute whether that order was a buy or a sell, right? So if you are not doing it real time, then you have to use historical bid ask prices, and I have found those to be inaccurate, right? So what I would like to do is you just want to save that data. You could just say, oh, okay, but I calculated it live and then I just want to save that. Okay. But then what happens if you change your algorithm? What if I found a way to do cumulative delta that is a little bit more accurate in fast markets? Okay. Even when the spread is really low. Okay. All of the data that I had previously, because I'm only saving the result of my processing, all of that data from previously is no longer good now. And now I have to start collecting the data all over again. So why not just save all of the updates that you get? Every level 2, every volume update that you get, and just store that. And you can do interim processing. You can do that processing and you can give that to them if that's like the common thing. But then you always have the ability to go and grab this other bit. You get what I'm saying? That's what I'm trying to do. And then it would be nice at that point to then let other people get access to it. I think that it would have to be expensive. It would probably, given the resources involved and everything, would probably have to be like $100 a month sort of thing. I don't know if there's really that many people willing to go that deep into it. There are certainly people willing to go deep into it on some of these other websites like Quant Connect, but they're doing like just price. You know what I mean? They're not doing order flow. So I don't know. But what I'm leaning towards doing right now is just doing it all on my machine, but keeping it cloudized. So basically, I'll run my own cloud, right? I'll run a Kubernetes cluster over here, and do my work on that Kubernetes cluster. That way, if I ever do choose to move it up into the cloud, there won't be any changes required. I'll just have to upload my repository over there, and that's it. Because the thing is basically like the data engineering part of it. I can do that. I've done that stuff before. Nothing quite this serious, but it's always kind of been tangential to what I do. So I can get all of the data engineering and monitoring for a system set up for a really good data pipeline. It's the doing machine learning on that part that I don't have. So I'm sitting here like, okay, we'll get the data pipeline together, and hopefully somebody to help us, somebody that's more experienced with the machine learning part, will reveal themselves. You know what I mean? Man, they got one right back up to the top. Okay, so what's going on right now, I'm realizing, is they were coming back. We got as high as what, 19? Yeah, we got as high as 19. I was waiting for them to go another little step, and maybe I was going to get a good buy in there somewhere or something like that. The 30-year is crashing a lot harder than the others. The 30-year just broke new lows. The 10-year is not even close to it. Yeah, the 30s is dumping. So because I did not keep a close enough eye on the spreads, I kind of missed the opportunity. They're well below the previous lows. There's still kind of a significant point at, let's say, 141 in the 30-year. Oh, you have some experience in building models. What do you want to train the model to do? So what I want to train the model to do, the thing that I'm most interested in is, I suspect that there is some sort of Markov model state at play with the imbalance in limit orders. There goes mortgage rates. Yeah. If you were hopeful that maybe you were going to buy a house. Sorry, guys. So, like, when you look at the level 2 right here, right? Well, I have a lot. I'm showing a lot of levels, but you can see here at the top, there's like the cumulative. Okay, is like 54,000 contracts on one side and 48,000 contracts on the other side, it looks like. Right? And the question is, when you look at the balance between those two, can that help you make trades? Because there is some empirical evidence that on very short time frames, that when you see those imbalances, they can lead to very high probability trades if you're fast enough. We're probably not fast enough to take those. But so then the question is, okay, so if I take a little bit higher of a view, maybe I do some filtering on that data, because there's a lot of stacking and pulling and spoofing and stuff. So I can kind of filter those based on like what the maximum and minimum that price, what that particular level was in a given time, and the differential between the two of them. And then you pass, a whole bunch of other features into the model, like the cumulative delta and the price and the amount of autocorrelation in it and so forth. And the idea is that that would maybe produce us a Markov model that would give us a better prediction of what direction the trend is. Yeah, that's kind of the bigger idea. The other side of it is, if I look at all of those things on the 3 instruments against each other, does that give us a better idea of where things might turn and so forth? So the ultimate idea is to create a scalping robot in the 10-year or the E-mini. Another thing that I would like to do after that, well, maybe I shouldn't do it after that. Maybe I should do it first, is to put a market making robot on the micro 5-year. Because the prices over there are a little silly. $0.97. So this one right here on the micro 5s. Yeah. Well, let's reset this current trades columns over here. It looks like there might still be some congestion in the 12 area though. I need to do this better. Can I make my own grid? I think I can. Hold on a second here. Where's my icon toolbar? That's not right. That was weird. Well, I went through all of this effort to like give myself a little better monitor here to see what the yield should be, and it didn't. It's not updating. The 1 year has the highest yield. Yeah. Oh man, that's a little silly. The 6 month is at 5. When you get to the 3 month is when it really comes down, and then it's 2.5. But the 5 year, there's room to bring the spread in here. There's a considerable amount of room to bring the spread in here. Related. I wish I could change like the background. Maybe, well, let's try that. Nope, that's not what we wanted. Maybe it's quote that I want. Yeah, you can add me on LinkedIn. They want to predict if a market is going to trend. Well, I wouldn't call it, say it is as exact as that. It's kind of more like which direction is it more likely to go today, and how certain is it that it's trending. But yeah, you can find Speculator Seth on LinkedIn or message me or whatever. The best way to get a hold of me is on Discord, though. I don't think that this quote window is the what I want. I think that it's monitor. Is just that when I add my note onto it, right? RT yield, RT yield. There we go. 29623. Yes. I see. SEC. 29589. Yes. Okay. Delete column. Deleted. Deleted. Also deleted. Deleted. Right, and then I think I can come in here, maybe in preferences, spacious. I want to make like the font a lot bigger. Display style, general, blah, 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 cancel out. Filter, format, column options, sort, column. No. Gotta be a way to increase the font. There's gotta be a way. If there is low liquidity during major new events, why is it that the major volume bars right after the news usually the highest during any given session? Well, because volume and liquidity are the different things, right? Liquidity is how much volume there is per price. Volume is how many trades actually take place. So if you have a high volume and low liquidity, what it means is that you're going to have high volatility. It's going to move more. Right? Price is going to move more than it would otherwise if liquidity had been higher. Huh. The little icon that I had for no, it doesn't. No, it won't let me format it. No. Maybe it's in the more general options. Trying to build your first PC, are those good components? 32 gigabytes is, so you're on the higher end here. You're doing a 69 XT. So, I mean, the components that you have listed there all seem pretty decent at current times and would certainly be enough for trading. I don't know about like if you've got all of the components compatible with each other or anything. I would make sure you go to buildapc.com and put those components on, and it will it will alert you of any kind of incompatibilities or anything. But if they do, I think that would all be fine. Like, you know, the whole thing with the whole thing with building a computer is that just about any computer will probably do for trading these days. But if you want to spend the money, that's a question of like, where do you want to spend it, right? I think that having the really fast disk space is probably the first place where I would put the power, right? And the processor as well. And it looks like that's what you're doing. So I think that would probably be just fine. It's hard to believe my 7700K is 5 years old. I know it's getting kind of crazy. Hardware hasn't moved much lately, has it? I wish I could see where the dollar ended up going to. That kind of makes this hard to trade. But you know what? The way that it's been trading here, I mean, we are kind of getting into the period where I might want to take a trade. I'm still trying to make this, my icon thing here, like bigger. There's like format, and that doesn't change it. Ooh, there you go. Zoom in. Okay. I can just keep zooming in, keep zooming in. Okay. It says 2.948. Wow. Well, now that I've got it out there, I think that it's unlikely that anybody will hit me. Can't believe I was looking at 2.8 at one point. That would have been $50, man. That sucks. You know what? I really don't think that I came in ready to trade today. I think I was, been feeling a little tired that night. I think that it was my allergies. I wasn't taking my allergy medication. But now today, I kind of was a little too pansy in certain key locations, and then when it went down, it was a little bit too fast. Kind of hard to be sitting on the sideline during a really clear trend, especially when you have really strong news like that. But no, not liking the way that's going. Three, two, one, huh? The micro 2-year is pretty well bid. The 5-year could probably be bid. I mean, you could probably take these out like right now 296, right? So you could probably bring it in at least 4 ticks on what it is. I don't know what you'd want to put for the offer though. The spread is bad. The spread on the cash has come in. The spread on the cash has come in, but the overall spread is still pretty bad. And the over here on these, it's like really, really awful, right? 2955. It like it keeps moving down for whatever reason. The S&P 500 has recovered almost all of its losses. That doesn't seem sustainable to me. By the way, on my sim trade, where was it that I had gotten out? Well, oh yeah. I totally picked the bottom. Wow. Suspicious. Well, there are some reasons, there are some technical reasons why we're seeing support in the E-minis. No. I was too pansy to take any live trades today, so I had gone short the treasuries, you know, worked in a position, and at that point I was letting it run, and when I started to see the big orders at 12, I got out. So I had picked the best spot to get out at that point. Not that it won't go lower, but it was a good temporary. I mean, if I got out of something and then I've been sitting for 45 minutes, that's a good trade. Yeah. You're sick? I haven't been feeling very good this week either. I don't think I'm sick. I think it's like allergies and stuff. It's like the energy is gone. Got so much going on in my head though, like, oh, I got so much done at work yesterday. I got a decent amount of stuff done on our stuff, but I haven't written the script for the video that we need to make this weekend, so that's kind of a problem. Need to do that today. May have to spend the morning writing it and the afternoon recording it or something like that. Man, the 30-year really is getting crushed here. So like there was significant steepening off of the initial move, suggesting that people bought the 2s and 5s, right? Or sorry, not that. They sold the 2s and 5s rather on the initial move, but then ever since then the yield curve has been evening back out, reverting back to where it was. So I think we should put that in as one of the stronger flows right now is retracement in the flattener. Let's come back to a zero hedge and see what they got here. Okay, Wall Street reacts to phenomenally strong jobs report. China sanctions Pelosi. Okay. Massive beat in payroll sprint has moved any hopes of a Fed pivot and sent rate hike expectations soaring, with the odds of a 75 basis point hike in September now topping 70% once again. Can you share some of the order book data on Discord? You're talking about the raw data that I've been saving? I mean, it's like a 200 megabyte file, so no, can't share it on Discord. How do I save my current workspace? How much was a year of hosting? Well, it was like $1 a month. It's like $1 a month. Well, that was for one instrument after a year. For one instrument after a year, my estimate was $1 a month. So $12, I think. So I was sitting here, I was like, I think I'd have to, you know, if I was going to make it available to other people, it'd have to be like $100 a month subscription. I was basing that just off of like what that data would be worth, generally speaking, because, you know, like you want like our API Plus is $100 a month, right? This is just historical data, but still. That price might still be justified just because of the amount of infrastructure I'd have to buy and I would need more than just the storage nodes, right? So let's teach people to man up and become more scientific about trading. I think that I need to not be such a big pansy in front of certain large events first, right? Because I could have made another $50 today and I didn't. So I'm a little unhappy about that. We don't smile in here, we kill. Well, I tell you what, it's one of those things. The way that the treasuries move when they're going to the downside can be really tricky, because when they're buying, what you're gonna see is like really forceful order flow, market orders just shoving and pushing out of the way, and you know, like there might be people taking profits up in here, and there might be big icebergs, and they'll just plow through it, right? But when they're going down, it's just like it just slips down to the low of the day, and you're like, what? How did that happen? You know? you can't take your eyes off of it because it'll happen so quickly, and it will often happen on like no volume. And we're definitely seeing that today, right? So if I close icon here, does it? Workspace 2 has been modified. Do you want to save it? Yes, save. Okay. Turn this 5-year DOM off here. I think it's too late for me to try and take a trade today. And I think that I'm probably okay not taking a serious trade just because, I mean, I really could have taken it when we were back at 28 is really with the place. During the news, if I had really been prepared, I think I could have taken 120 or whatever. Because that's where it initially came down to, and I probably could have sold it there. I would have taken a lot of heat, but I think that would have worked out really well. And that probably could have given me 60 or 70 bucks. But, you know, I was sitting there. I even put a bid out at 2.8. I think I can show that. Let's see here. Orders. 10-year. Yep. At 636. Oh, so it was only 6 minutes after the news. I pulled one out at 2.8. And it didn't do it. It wasn't like immediately going into the right price. If I had held it there, I would have gotten filled, but I canceled it and I didn't. So adds to losers all the time. But that's the way that most noise traders do it, though, guys. Wait, he's doing price action, so I'm gonna put it in the category of noise. But that's not to be an insult. That's a technical term based on the empirical research, right? He doesn't know what's gonna happen, and he's not the market maker. Then it's noise trading. But a lot of how noise trading works is taking on excessive risk, adding to losers, and so forth. I don't like adding to losers, but I definitely screw around with the risk on sim, right? I'll come in, I'll take up to 5 contracts. Then when it runs, I'll take a couple of them off and let it ride. But when I take a loser, it's bigger. When I take a loser, it is bigger. Okay. Wall Street reacts to today's phenomenally strong jobs report from Zero Hedge. We already know the markets have responded to this morning's good news in the jobs data. Rate hike expectations soaring, bond stocks and bullion crushed as the dollar spikes. The market is now pricing a 70% odds of a 75 basis point hike in September, up 25% from the start of the week, and over a notably 7 more aggressive tightening cycle than was expected a week ago. Now, we hear from Wall Street's best and brightest. Omar Sharif, founder of Inflation Insights LLC, says 75 basis points next month from the Fed is now the base case. Randall Cosner, a former governor at the Fed and now an economics professor at the University of Chicago's Booth School of Business, speaks on Bloomberg Television. I think it's really clear that they are on a path to continue to raise those rates. Certainly 75 basis points will be on the table for the next meeting. The thing is, not only the strength of the labor market, but it is also the significant increase in wages higher than expected upward revisions. Bloomberg's Ven Ram. This is phenomenally strong jobs report, way stronger than forecast and more than the average payrolls expansion for the year through June. This will increase chatter for a 75 basis point move from the Fed, and the reaction should be along those lines. Neil Dutta, head of U.S. economic research at Renaissance Macro Research LLC, warns we may be in for a hard landing now. This jobs report is consistent with an inflationary boom. The Fed has a lot more work to do, and in an odd way, that the Fed needs to get more aggressive in pushing up rates makes the hard landing scenario more likely. Bruce Richards, chairman and CEO of Marathon Asset Management, a $24 billion global credit manager, thinks the Fed should be more aggressive. Tight labor conditions continue. Growth in employment is hugely impressive, which will undoubtedly require the Fed to tighten the financial conditions more than the markets have assumed. Eric Theoret, global macro strategist at Manulife Investment Management, for the Fed, this report confirms the need to continue tightening and also endorses much of this week's Fed speak that sought to jawbone rate expectations. For markets, this report may pose a challenge for rate-sensitive equities like tech, which had recently been leading in terms of sector performance. Can you imagine what would have been happening today if the Federal Reserve hadn't come out so aggressively earlier in the week and said, you know, we're going to continue raising rates and everything? Like if they had not done that, the treasuries would have been in like an absolute panic today. Because like really today we got 5 basis points more in the 10-year. But it was really, if we go to like the low of the session, it was really more like we were at 7.5 at one point, right? Yeah. Or actually, oh wow. So it was actually more like 25 basis points. But you know, we were like at 2.75 earlier in the week. It's just a little crazy to think about that the market has been fighting the Federal Reserve on this. Next week, some data comes out and their tone will be more dovish and things aren't as bad. I don't know about that one, man. I'm really concerned about the July CPI report, dude. Why am I saying that? Why all that movement pre-market? Is the job openings? Well, there is a job openings report that gets released the day before that is like not from the BLS, but from some other company that estimates how many job postings there are currently. Jobs that haven't been filled yet. Maybe that's not what you're asking. Oh yeah, because NASDAQ Killer wasn't here. Okay, so here's what happened, NASDAQ Killer. The non-farm jobs report expectation was 250,000 jobs. And we got 528. So we got almost double the expected result. It's a 6 sigma event. Meaning that the amount of beat is like 6 times the standard deviation. So like extremely rare tail event. Oh, we're gonna listen to drum and bass now. Boom, 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 boom. Eric Theoret, global macro strategist at... Oh, no, not that one. Mark Cabana, head of U.S. rate strategy at Bank of America Global Research, says the report is truly strong and suggests more work has to be done by the Fed. It means the 75 basis point hike in September is very much in play. The market is saying if the Fed is truly dependent and if other data is similarly strong, the Fed needs to go faster. BI's currency strategist Audrey Childe-Freeman sees today's print as a win-win for the dollar. This is a dollar bullish report as the market seems to focus more on recession fears. The indisputable strength in the U.S. employment report suggests there's still room in the U.S. despite the lags in the labor market, and this is a green light for Fed hawks. This confirms this overwhelming yield-driven dollar bull case, and if Fed hawkishness triggers renewed risk off, the dollar should also benefit from safe haven flows. I agree. That's why it bothers me that I can't see the dollar here. It's not updating. Which is good, right? But why they sold it afterwards? Because good news is bad. Really strong non-farms payroll report suggests that the Federal Reserve's interest rate hikes are not accomplishing the desired goal, which is to bring the labor market back into alignment. They want to see unemployment move up a little bit. They want to see inflation back off. And if jobs are that strong, that means that the Federal Reserve is probably going to raise interest rates another 75 basis points. And that's very bad for stocks, especially tech stocks that have a lot of debt or that like to take on a lot of debt. Florian Lalepo, head of macro research at Lombard Odier Asset Management, says so much for the macro slowdown. This data point is clearly indicative of how tense is the job market these days. This means wages progressing, and this also means the Fed is far from having done its tightening cycle. Markets need to prepare for a hawkish Fed and a hawkish ECB alike. 4% in the US and 2% in Europe are no longer fantasies, and the economy is so far barely reacted to the tightening. Time for central banks to act tough. Time for markets to brace for tighter monetary conditions. Matt Maley, chief market strategist at Miller Talbot & Co. Never heard of that company before. The employment report means the Fed can keep tightening to the degree they've been saying in their Fed speak this week. The market has been pricing a more dovish Fed in the near future. This report tells us that this is going to be very unlikely. Gregory Farinello at Amerivet Securities says, don't fight the Fed, don't fight Bullard, and that the 2 and 10s Treasury curve inversion is set to test negative 50 basis points. Oh, that would be so insane. Could you imagine the 2-year at 3.5 and the 10-year at 3? What? That would be nuts. That would be so crazy. I just can't even imagine. So we're treating the Fed's wrong. Well, the whole thing is that the market has kind of been fighting the Fed this week, and it turns out the Fed was right? That's what that's all about. Linda Dussel, senior equity strategist at Federated Hermes, says the jobs report erases Fed pivot hopes. Earnings surprise is the highest since October, so wage growth still strong. Biggest concern, participation lowest since December 2021. Evidence of structural tight as drum labor market. Wage price spiral, question mark, 1970s, question mark. We will watch jobless claims as the most important figure for when the Fed will stop. No time soon. Dennis de Bouchere, founder of 22V Research, says of the release in simple terms, this points to the Fed needing to tighten financial conditions more. Yeah. Well, the 30-year just keeps dragging them down. The 30-year just keeps going, and they are below that significant support area at 141 even. Or what would have been technical resistance on a chart. Doesn't mean that we want to take a reversal there or anything. It's just an interesting spot to look at. Steve Sosnick, chief strategist at Interactive Brokers, the jobs report really disrupts the market narrative of expectations for a Fed policy pivot, and the data is very market unfriendly. Buy the rumor, sell the news. Is this a play in futures? Well, so I think that is a poor heuristic. I mean, generally speaking, that does kind of work that way, but really what you want to look at is orders, right? What are the orders going to do based off of this news? Now, one of the things that will affect the orders that happen after the news is the current positioning. So if everybody is already short, that's going to affect what it does afterwards, yes. But when you get the thing in this case was that this really was just so far out of line with what anybody thought it was going to be. I think there was one analyst saying that there was going to be 450. I'd like to know what their thinking was, but nobody expected it to be 528. It's just batty. Marcus Schomier, chief economist at Pinebridge Investments, makes me worry an ill-focused Fed will see that as a vindication of rapid rate hike strategy, but I have called the current backdrop a tightly packed economy where labor markets are the wrong indicator to look at to judge whether the economy is strong enough to withstand tighter monetary policy. But the recent Fed speaker suggests that it's the only thing they're looking at. So, in a nutshell, This was a bad report that actually raises recession risks because the Fed will feel rates can rise further, which may push the economy into recession in quarter 3. And finally, Academy Securities' Peter Cheshire notes that the Fed will not be able to ignore that wage pressure. Weekly hours worked got to 34.6 and were revised higher last month, which tends to be another positive. The household survey only shows 179K jobs and still shows job losses last month. The divergence continues to grow between the establishment and the household, as well as the JOLTS data and unemployment insurance claims. And here's the chart, the most recent chart. I mean, it's definitely a thing going on. Where's my pen? Maybe I need to just open up it again. There you are. You see this? We continue to get a really strong trajectory this way, and the household survey is saying it's going flat. What's going on? There is definitely something going on in the reports. Something fishy. Something that... Why am I not seeing more people try to explain that difference? Unemployment rate ticked lower to 3.5%, though that was driven more by labor force participation dropping to 61.2 than the jobs created in the household survey. I'm sure somewhere in the details there might be some things to nitpick, but the report, especially the establishment report, puts the Fed firmly back in the hawkish camp. Why the report is so much better than any estimate and seems inconsistent to some degree with other jobs data is a question to be asked. Yes, it is. Oh look, and now they're trying to ask the question over here. Because now I go back and there's another story. Something very odd emerges for the second month in a row when looking at the July payrolls report. Recall last month we showed that a stark difference has opened between the household and establishment surveys that make the monthly jobs report. And since March, the former was sliding while the latter was rising every single month. In addition to that, full-time jobs were plunging while multiple job holders soared near all-time highs. Guess what? At a time when the Biden administration is now being accused of fabricating energy numbers to push oil prices lower, the jarring divergences and inconsistencies in the jobs report just hit escape velocity. Consider the following. On one hand, the closely followed establishment survey came in red hot, and not only did it soar despite the US entering a technical recession last week, it printed at a 5-month high of 528K, a 6 sigma beat to consensus expectations of 250K, and with wages also coming in hotter than expected, rising 5% month over month or 5.2% year over year, it was enough for many to conclude that calls for a recession are premature because, after all, you can't enter a recession when jobs are rising by over 500,000. True. But a problem emerges for a second month in a row when looking at third-party data which tracks the number of new employees laid off as well as new layoff events, both of which have soared since May, yet have unexpectedly not been reflected in BLS data. But even if one ignores outside data sources, a more pressing question emerges when looking at the BLS's own, far more detailed, if less closely watched, household survey. Here, unlike the establishment survey, the June jobs change was a far smaller 179K increase following last month's 315K drop. And since the household survey also feeds other closely watched ratios such as the labor force participation rate, it explains why, despite the apparent surge in June jobs, the LFP declined for a second month in a row and is now back to levels last seen in 2021, the labor force participation rate, that is. So what is going on here? Well, those who read our article from last month will know what's coming next. Those who haven't will be surprised to learn that something appears to have snapped a few months ago around March, when the establishment survey kept on rising unperturbed while the household survey hit some unexplained brick wall and hasn't moved at all. In fact, since March, they're just saying the same thing over again. Get to the point. Do you have a theory? In fact, since March, the establishment survey shows a gain of 1.68 million jobs, while the household survey shows an employment loss of 168K. But wait, there's more, because digging in even deeper, we find that this drop in household survey employment is a result of both full-time and part-time jobs. In fact, as shown below, since March, the U.S. has lost 141K full-time employees and 78K part-time employees. This trend has persisted into June when, according to the BLS, the U.S. labor force saw a 71K drop in full-time workers, offset by a 384 gain in far lower-paying part-timers. The offset, multiple job holders or people who have more than one job. This trend has persisted into June when, according to the BLS, the U.S. labor force saw a 71K drop in full-time workers, offset by a 384K gain in far lower-paying part-timers. The offset ? Multiple job holders are people who have more than one job. As shown below, while the number of total employees per the household survey has stagnated, the number of multiple job holders has been growing steadily, hitting a new post-COVID high in June of 7.541 million. The increase for June, 92K, which stands in stark contrast to the sharp drop in full-time job holders. But even more notable is that since June, the U.S. has lost 141K full-time jobs, 78K part-time jobs, while adding a whooping 263K multiple job holders. And even more remarkable, the number of multiple job holders whose primary and secondary jobs are both full-time just hit a record high. Hardly the sign of a strong job market where people can afford to quit jobs at will. Multiple job holders, both primary and secondary job is full-time. It's a new record. Okay, so what's going on here? The simple answer: fewer people are working, but more people are working more than one job. A rotation which picked up in earnest sometime in March and which has only been captured by the household survey. And since the establishment survey is far slower to pick up on the nuances in employment composition, while the household survey has gone nowhere since March, the BLS data engineers have been busy goal-seeking the establishment survey, perhaps with the occasional nudge from the White House, especially now that the economy is in a technical recession, to make it appear as if the economy is growing strongly, when in reality, all they are doing is applying the same erroneous seasonal adjustment factor that gave such a wrong perspective of the labor market in the aftermath of the COVID pandemic, until it was all adjusted away a year ago. In other words, while the labor market is already cracking, it will take the BLS several months of veering away from reality before the government bureaucrats accept and admit what is truly taking place. We expect that realization to take place just after the midterms, because the last thing the Biden administration can afford is to admit the labor market is crashing, in addition to the continued surge in inflation. What do you guys think about that? Isn't this job report also depending on demographics? I mean, in my opinion, we can have a recession with strong labor market because there are just not enough people to fill all of these available positions. Well, Tobias, I think you're kind of on the right track there. I think what they're saying is that a lot of people did get laid off, and that the actual number of people that are working is less. But the reason that they were able to have a higher number is because people were picking up part-time jobs or working multiple jobs. So probably there's a lot of people that work from home and they picked up 2 jobs or whatever the deal is, right? Man, if I had 2 jobs making double what I do, could probably pull it off, but it would be really stressful. I'd have to take my medication and probably wouldn't be able to work out very hard. I just saw a report recently about a girl getting fired because she decided to make a TikTok video about her 20K raise. Wow, okay. So what does that mean? That means what Zero Hedge is suggesting here is that the jobs numbers are not an accurate assessment of the labor market right now, and that in a couple of months you will start to see the contraction as people realize what's going on, and they seem to think that this will probably last at least until November. In the meantime, though, the Federal Reserve probably continues to raise rates, right? They do it in September, and I think they have a November meeting. So hold on a second. September 20th and November 1st through 2nd. Okay, so there is a Federal Reserve meeting the week before the election. So that means if that theory was correct, and I'm not saying that it is, but I just think it's kind of interesting to look at because it does seem to line up with what I've been seeing in some of these tools. So if we come over to FedWatch here. Okay. Make it a little bigger here for us. And we are going to use compare so that we can see. Yeah, they changed over the last oh, this is current. Oh wow, okay, yeah, so they moved from, they thought that it was going to be 80% chance of a 50 basis point hike to now a 65% chance that it will be a 75 basis point hike. Okay, so 3 is 75. Okay, so they think they do 3 in September, and then in November, they think that it will be another quarter. Interesting. Because you would think that if that was 3, and then you wouldn't go from 3 to, sorry, you wouldn't go from 75 basis point hike to a 25 basis point hike, which would be this. This would have to be this right here. This right here would be 75 plus 50, which would be my base case, just my naive base case, okay? But that takes us to 350, okay? Now we look at December. And in December, they think that they are most likely at 350. Which would mean 75 plus 25 plus 25. And the 375 would be 75 plus 50 plus 25. Right? But very, very few think they will be at 3 now. So that is a change. We can now look at February. They think that we'll still be there. So from what we can kind of see in the bills market, they seem to think that we're going to get to around 350 basis points, and then it'll just stay there. So when we had all of the craziness that was happening, first of all, I did not hear the number correctly, because I could have just hit it, man. The way that it was, I probably could have just hit it. But then after it happened, I was a little bit worried about something hitting back. you know, you kind of have to look at this and like, oh, what were you thinking, Seth? You could have sold it just about anywhere and made money as long as you didn't sell it at 12, right? Well, the thing that I was worried about was that the number just seemed unrealistic. And I can recall at least two times when the jobs number in particular came out and I was like, what the heck? There's no way. And then we ended up digging into the data and finding something about it that suggested that the story was really not what we thought. Right? So that kind of scared me, the possibility, because the number seems fishy. Now, Zero Hedge, I think, has a decent theory. I think they have a decent theory on why we got the number that we did. Before, it was just kind of like, well, this is kind of an interesting thing in the report now. Now it's like the biggest question in the market, right? What's going to happen by Monday is everybody's going to have their own theory of what's going on here, right? And we'll see then what the market does with that. I don't think that I personally want to be in a swing trade, or, I was saying, well, shouldn't this mean maybe you do a swing trade, maybe the 10-year gets back to 3% and all that sort of stuff, right? I don't think I want to do that over this weekend. No. Because I kind of want to see where the market starts to come down on this question. What if you were the speaker for a news squawk and you misread the number to the... Oh, I'm sure that people would be upset. Yeah. I don't think they understand what they are talking about. Well, I think that we're just kind of in a situation where all of our metrics that we get are a little screwed up. So again, I feel like that anybody that comes out and says that they know what's going on in this economy is full of shit. There's no way to know. It's because we're flying half blind. We can't trust any of our instrumentation, right? We can't trust any of our instrumentation, and we're flying in uncharted waters. So how could we possibly know how it's going to turn out? The only thing that I can accurately predict, I think, is what the Federal Reserve is going to do. The Federal Reserve is probably going to raise interest rates 75 basis points at the next meeting. Now, the treasuries have been flattening considerably. It kind of looks, based on the way that this is going, that the 2-year will probably get to 3.5. At least 3.25, if not 3.5. But will the 10-year starting to steepen things back out? Will the 10-year get up to 3%? Or are they just going to continue to chill here around 2.85? That is quite a conundrum. It seems like that one can't go on forever. What's going to happen is GDP is going to slowly shrink? I don't know, man. How can we know? How can we know? It all just contradicts each other, right? So, I'll see you guys Monday. Stay profitable, friends, or at least don't lose it all, because apparently this zany market is just going to continue on and on and on. We're going to have plenty of opportunities. So, see you guys then. In the meantime, yeah, I said that. I said that already. Goodbye.